My name is Sumit, and I'm co-founder of Truemind Capital Services. Truemind Capital is a SEBI-registered investment management and advisory platform that provides unbiased, professional, and high-quality personalized investment solutions at an affordable cost. So we have, three key learning objectives in today's session. So first being why you must save. Uh, so I'll talk about, the kind of life we are currently living is, we have a lot of expenses, we aspire for a lot of things. And in that, sense, we sometimes miss out on savings, living a life of YOLO, you live only once kind of concept many people follow. But it could create a lot of problems, and that's where, I want to explain why it's very important to save along with, also aspiring for things you like. Second, I'm going to talk about how to best utilize my savings. So, after understanding the importance of saving, and then how we can utilize our savings in the best possible manner. Third, I'm going to talk about is five financial mistakes to avoid. So these financial mistakes are, the traps in everybody's life, which one needs to avoid to be able to, better their chances of getting a good financial future. So I talk about those traps and how we can avoid those, in detail. So first is importance of savings. So, I would like to begin with the story of Ryan Lochte. Uh, he was a genius, and he still is a genius. And he started his career way back and won the first Olympic gold in 2004. In the next 12 years, he bagged 12 more Olympic golds, and he's quite popular and a decorated swimmer. And naturally, he earned a lot of millions of dollars during his career. But after 2016, within few years, he went broke. So let me give you other examples. Michael Jackson, when he died in 2009, he had net debt of something, in many hundreds of millions of dollars. So he was in debt that time, and even Mike Tyson, if you are aware of, he went broke. Then Boris Becker, the news of Boris Becker came a few years back that he went broke. He was a legend in tennis, lawn tennis, and he went broke. So there are many people who have earned a lot of money and then went broke. So now tell me, what do you think would have been the reason for these famous celebrities to go broke after earning so many millions of dollars? uh, you know uh, they didn't keep track of it. So problem with higher earning is that when you earn a lot of money, when your income rises, your expenses also rises along with the income. Sometimes expenses rises more than the rise in the income, and you are in the false sense of security that your income will continue to remain at these levels or it will continue to rise. So many of these celebrities have their expenses risen to such a level that when their income declined, the expenses didn't fall by the same proportion. Because you once you are used to a certain kind of a lifestyle, then getting away or reducing that kind of a lifestyle is very, very difficult. So when the incomes fall, expenses do not fall in the same proportion, and when you do not have enough savings meet those expenses, you end up losing everything, and you go broke. So that's where that's one of the reasons. So what happened with the Ryan Lochte is, in year 2015-16, there were few scandals he got involved in. He lost many sponsorship deals, and he was not allowed to participate in following Olympic games. So that's where he lost a lot of amount of income, while his expenses were very high, and he didn't reduce, he couldn't reduce those expenses. That's why he suffered such a major financial problem in the following years. The future is highly uncertain. When we think that our incomes will continue to remain at these levels, we are just cheating ourselves in believing that. So because you never know, what happens the next year. So, given the example, we are in a situation of COVID-19, and many people, had a fear of, losing their job. Many lost their jobs. Many saw, pay cut happening. So, all these people probably have some loans going on, or may have planned something, for the future. They have increased their expenses. But now, in a given situation, it would be very difficult for them, to meet their expenses. So the bottom line is, when your income rises, you should increase your savings more than your expenses. So the lesson learned by Ryan Lochte, in his own words, he explained. He tells, you have got to be smart. Any paycheck that you get, whether it's $5 or $50,000, you have to put some away, no matter what. Plus, no matter how much you bring home, it's important to keep your spending in check. Yes, you have to budget your expenses. That's something that I never did when I was younger. All this money was flowing through. I didn't have a family at the time, and I was living carefree and buying all this random stuff, and it caught up to me. So I think the message is pretty clear that whenever you are having any earnings, whatever income you are getting, you should, first decide how much you need to save, and then you look at the expenses. So, it's not that you should not enjoy your life, or you should save entire whatever you get. It's not what I'm saying, and neither I'm saying that you should be spending entire amount what you get in terms of your income on expenses, and piling up loans, buying expensive cars, living beyond your means. There is a middle path which Gautama Buddha also explained. One should have a balanced approach towards life. There has to be some savings, there has to be some expenses to enjoy life that you want, because you're ultimately earning to enjoy your life. So just I'll move for to the next slide with this quote. Take waste out of your spending, you will drive the haste out of your life. So what it says that a person who has a lot of expenses, he's always, running. He's always worried about, how I'm going to meet my, expenses going forward. So once you reach to a certain comfortable position with your savings, then you become more comfortable. Your life become more peaceful. So that is what you should aspire for, because your savings really tell how tall you walk. Now another example to explain why savings are very important. So this ET poll conducted a few months back. The question was, do you think what Indians save is enough for retirement? So 81% people said no. That means people have the sense, they understand that they are not saving enough for retirement, and still they are not ready to do make amends to their current way of living. A study done by Land Edu in US, on 1,000 senior citizens, they asked them what are their biggest regrets. So they told that first, the biggest regret is not saving enough for retirement. Second, regretted spending too much on non-essentials. Third, regretted not investing any money. So this was a study done in US, where the literacy is still far better than what we have in India. Here, as we all know, financial literacy is very poor. And imagine the situation of so many people here. There's definitely a study I read somewhere that many people are ill prepared for their retirement. They are not ready for retirement. They will have to continuously work even after 60 years, 65 years, just to maintain the upkeep of their expenses, their overall lifestyle. Basically, this should not be the retirement plan of anyone. So we cannot, just wish that things will improve or things, will be better in future. We have to really prepare. We have to plan for it. So now you understood the importance of savings. And next question is how I can best utilize my savings. So Warren Buffett, one of the most rich person in the world, with a net worth of roughly $60 billion. He made his net worth entirely by investing. And he has shared a lot of nuggets of wisdom. So we take help of one of his nuggets of wisdom, where he says that if you don't find a way to make money while you sleep, you will work until you die. So what he means to say is that you have to make your savings work for you, even when while you're sleeping. So your savings have to work for you. You need to invest in such a manner that you should have two sources of income. One source of income is your current job, the salary you are getting. Second source of income should be the money that your savings is generating. So next question is, how should I make my savings work for me? So here I introduce mutual funds to you. I'm sure many of you are aware of what mutual funds are. There are a lot of advertisements also all around, talking about mutual funds, which has like now bored people. What exactly, we have seen is many people are aware of equity mutual funds. They feel that if they are investing in mutual fund, it must be an equity mutual fund where there is a lot of volatility, a lot of fluctuation. People are not comfortable with this kind of fluctuation in their investments. So in reality, mutual funds are three types broadly. Uh, One is equity, where the investments are done in share market, where there's a lot of volatility. Investments are done in businesses like Tata, Reliance, HDFC. These are the big companies, and then there are objectives where the investments are done in small companies, maybe Hawkins Cooper, maybe Bata. So these are the companies where your investments goes when you invest in an equity mutual fund. Uh, there is another category, debt mutual fund. In debt, the investments are done in government bonds, government treasuries, or corporate bonds, FDs of sometimes banks FDs also, which are offering them higher yield, which is not easily accessible to many retail investors. So debt generally has very low fluctuation. The volatility in the investment is very low, and consequently the returns are also not too high. Whereas equity mutual funds have a track record of giving 12 to 15% kind of a return in last 15 to 20 years. Debt mutual funds would be offering, say, in the range of 7 to 9%. Then the next category is a hybrid fund. Hybrid fund is a mix of equity and debt. You have some portion, say 20% invested in equity and 80% invested in debt, and could be an aggressive hybrid where 60-70% is invested in equity and remaining invested in debt. So these are the types of mutual funds broadly. And so benefits of mutual funds, very quickly, they help you create wealth because you get higher returns compared to any other investment option. Second, it offers you a professional expertise. There is a fund manager who is highly qualified. Then he has a team of research analysts who again are highly qualified and focusing on different industries, different investments full time. And they provide a professional expertise and charge you some fees. Then there is diversification. You are not investing in one stock, two stocks. So when you invest in mutual fund, it spreads across 25, 30, 40, 50 stocks. So your risk with respect to one stock reduces considerably. So your risk is diversified. Uh, Another is transparency. So when you invest in mutual fund where all your investment has gone. There are many websites like value research online.com, moneycontrol.com, and many more such websites are there where you can see where your investments are finally going, which stocks the investments have been invested in, which bonds, government bonds or corporate bonds the investments have been done. So you get the idea of where your investment has gone, and you also know the value of your investment on daily basis. The NAVs are declared on daily basis, so you know how much you have invested, what is the value as of today, and what are the returns so far. Last benefit is they are tax efficient. So, compared to some other investment options like FDs, they are taxed as per your tax slab. In mutual funds, you are taxed as per the capital gain. In equity, it is like 10% after 1 year. In debt, also, it is roughly 10% after you keep it for more than 3 years. So quickly, mode of investment, we are aware of one-time investment, where if you have say 25,000, 50,000, 1 lakh, you invest one time. And if you think that market is very cheap, you can, put 2 lakh, 3 lakh money. So that is a one time. There's no commitment that you have to continuously make that investment again. And then there is a monthly investment, which very popularly known as SIPs, systematic investment plans. So here, you have made a commitment to invest a particular fixed amount of money on a fixed date in selected mutual fund schemes. So that is how your money gets debited from your bank account and gets invested in mutual fund. So that is a very disciplined way of making investment. So if you are having, you are all are earning salary, fixed salary, you know what is the amount that you will get, in your bank. You can always choose, this is the amount I'm going to save or I'm going to invest. So that will bring discipline to your overall financial management. So now mutual funds are also, there are 4,000, 5,000 schemes, and it's not easy to identify, which mutual fund one should be investing. Just by going, looking at the past returns, so that won't give you a good idea. So which mutual fund should I invest in? That depends on your purpose of savings and investments. So you should have, you should assign purposes to your savings and investment. And the best way is to, bucket it into two timelines. One being short term. So any goal that you have, any major financial requirement you will have, a funds requirement you will have, say within less than 3 years. So that forms your short-term goal or short-term horizon. For example, you have planned to buy a car, say after 2 years, and you need say 5 lakhs. So that is your short-term, goal. You need 5 lakhs after 2 years to meet that expense. Then there are long-term goals, which are, if you're married or when you get married, then you have, if you choose to have children, then you can have, goals like children education. The education cost is also rising rapidly, and in another 15, 20 years, it will be very high. So child education is something that becomes a significant a big goal for many people. Then, if you plan to buy a car, that could be, after 3 years or 5 years, then you can plan for buying a car. Or buying a home, you can also plan, say, 10 years or 15 years down the line. And another, long-term goal, which irrespective of which, personal situation you are in, you have to plan for your retirement. Retirement is something nobody can escape. So that is something everyone have to prepare for their retirement. So there are some simple hacks, just to explain how you can best utilize your savings. First, when the period is less than 3 years, basically a short-term horizon, you can always, whenever you get your, income in your bank or from any other sources, the money that you get, immediately park that money in liquid fund or ultra short-term debt fund. So the benefit of parking in those schemes is that you get say 5 to 6% annualized returns, whereas in savings you get 3% or 3.5%. So when you park your funds in these schemes, you get higher returns. These schemes are reasonably safe, and they are very liquid also. So if you need say money next day, you can redeem today and it will come to your bank account tomorrow. So it has to be working day where you have to target these redemptions. And for example, your salary comes say in the beginning of the month. You put that salary to these funds, and then you have certain utility bills to meet, you have certain credit card bills to meet. So that is, for example, happening say on 15th or 20th. So just 2 days before, you have to pay for these expenses, you take out money 2 days before that and then pay off. So that way your money is actually working for you better than just keeping into savings account. I have seen many people really do not care. A lot of money is sitting in this savings account, and they really do not know what to do about it. And that's how they lose a lot on returns in terms of opportunity cost. So just by parking in these safer liquid debt fund options where there is not very little volatility, you can get higher returns on your savings. Also, one fact is that when you have higher savings reflecting in your bank account, you're always tempted to spend it somewhere. So it's better to take out from your bank account and park it in these funds so that you do not overspend on anything. So when you have investments to make, for a particular goal, which is more than 3 years, then you can start a systematic investment plan or SIP in equity and debt mutual funds combined. I would not say that it's wise to only start in equity. You should have debt allocation also, because as you accumulate in debt, when the markets are at much lower level, you can shift your money from debt to equity side to take advantage of the opportunity. So when you start SIP, a fixed monthly amount is deducted from your bank account for investment in mutual fund schemes. The benefit of SIPs are it reduces risk because of averaging. So you are not investing one time at at the market level, which are very expensive or which are high. So you are just SIPs you're investing higher market levels as well as lower market levels. So it averages out over a longer period of time. So SIP can be started with very small amount as well. You do not need lakhs of money to invest in SIPs. You can start with as low as 1,000 rupees per month. So that is also you can begin with your SIPs. Third, then when you are making SIP, you do not need to time the market. So your average SIPs are averaged out over a long period of time. And when you really have to even invest when you perceive that markets are too cheap, that time you can switch from debt side some portion to equity and take advantage of the opportunity for a higher upside potential. Then you can align your long-term goals with SIP as I explained, and it brings discipline to your overall investing approach and takes out emotions out of the equation. So when you tend to make emotional decisions, there are high chances that you will make wrong decisions. So so here we have come, many people are not aware that they can make investments in mutual funds in ELSS category and save tax up to 46,350. So usually, many times people end up investing in some insurance policies or some bad products like maybe 5-year FDs which are not generating much returns. What I'm trying to say is that you can invest in ELSS funds. You can start an SIP in ELSS fund. For example, if you have to make up for 1,50,000 in one financial year, you can start SIP of say 12,500 from the beginning of the financial year, from say April onwards, and then at the end of the financial year, you will it will sum it up to 1,50,000. So there are other various options, for tax saving, which are public provident fund. That is again a very good option because it offers you entirely tax-free returns. But there are other options like NSC or maybe a term insurance plan you can look at. But investing in ELSS funds over a longer period of time can get you much higher returns than any of the options available. But one exception I would like to make here is in case you want to make a lump sum investment, you did not plan from the beginning, and at the end of the quarter when you are asked for investment proof, you rush to make investment somewhere. At that point in time when you are investing when the markets are very very expensive, I would say you avoid investing in ELSS funds, mutual funds at that point in time. You can probably choose PPF, which can offer you better risk-free returns in the long term. So many people say that they are worried about negative returns in equity. Can I avoid investing in equity mutual funds altogether? Unfortunately, you cannot. because there is a risk that we underrate significantly is the risk of inflation. So what inflation does, it eats away your money slowly. What you could bought say 10 years back, you will not be able to buy the same thing uh, from the same amount as of today. So what exactly, all of us have seen, the bar of Cadbury Dairy Milk. We could get it for 10 rupees and we could get a big bar. But now, you purchase for 10 rupees, you get a very small piece. And, what used to be for 10 rupees earlier is now costing, say, 30 rupees or 40 rupees. So inflation, everybody understands, what we can buy today, we won't be able to buy with the same amount in next 5 years or 10 years. So what does that mean is if we are not earning, more than 7 to 8% on our savings, our purchasing power is declining. Our ability to buy things is declining. So what we have to ensure that whatever we are saving, it should earn at least at the rate of inflation post tax. So whatever you're saving, there would be taxes in terms of capital gain or interest income, but you have to find out what is the post tax earnings I'm getting. It should match with the inflation rate. So we should be at least making 7-8% returns on our savings post tax. So basically, when you invest in fixed instruments like FDs or, in safer debt mutual funds, you end up getting returns in the range of, in FDs, you will be taxed as per your tax bracket. So your returns so even the FD rates right now at very low level at 5.5%, 5%, we end up getting say 4%, 3.5% finally after taxes. And when you invest in only debt instruments, you end up, say getting 6-7% at max over the long term. So, we are not earning enough to beat inflation or match inflation by investing only in fixed instrument. So it becomes very essential for everyone to allocate some amount in equity, because equity have track record of getting returns in the range of 12 to 15%. And if our economy continues to do good, and if our economies, grow by say 5 to 6% real GDP over the long term, equities will give roughly 10 to 12% returns in the long run. So that's where if a mix of equity and debt, we can ensure that our returns are at least matching the inflation rate, and our savings are keeping it's going as per it's matching our purchasing power is maintained. So that's where we need to focus on, and a mix of equity and debt is essential for any portfolio. Also, since I explained, when your goal is short term, less than 3 years, horizon, then you should not be investing in equities. You can invest in, risk free or low risk debt products. But if your goal is long term, then investing in equity makes sense. Equities are definitely volatile in the short run, but equities generate very good returns on an average in the long run. So it's a chart of, Infosys stock from year 1994 onwards, and for the next 20 years, there had been many declines that happened in Infosys stock. Decline of 74%, 50%, 33%. Very sharp declines happened, over the period of time, over the period of 20 years. But the average returns that anybody experienced by keeping investments in Infosys share, he or she could see 46% compound annual growth rate on his or her investment. So that's where equities are volatile in short run, but in the long run, the returns are quite good if it is done thoughtfully and thoughtfully, and after doing study properly. So what needs to understand is that equities are volatile, uh, and do not get afraid of any short term volatility. You have to keep it for longer term to ensure that okay, my returns will be good as the economy also is continuously growing. So next I'm going to talk about is asset allocation. As I was explaining earlier, uh, so if you have say 100 rupee of investment to make, or if you have 100 rupee of saving, you have to decide how much of that 100 will be allocated to equity, how much of that will be allocated to debt, and how much of that will be allocated to gold. So this allocation, in different asset classes is called asset allocation. And you can decide your asset allocation which is suitable to your requirements, to your investment objective, based on how much risk you can bear. If you are, if you're very conservative, then you should not have, say, 20 to 30, more than 20 to 30% in equity. You can, have just 20, 30% either in form of equity mutual fund, or, maybe direct equity also, if someone is very experienced about how to pick direct equity and can afford to spend a lot of time in keeping the track. Then in the debt side, you can, choose to have it in maybe in FDs, or maybe in debt mutual funds, or maybe in a long-term government bond. So it could be a mix of things, or maybe a PPF. So, you have to decide, okay, if I'm allocating, say, 60% in debt, then I will be allocating, say, 20%. So then you have to look at the sub-allocation, say 30% in FDs, 20% in PPF, or, 20%, 30% in debt mutual funds. So that is a very important aspect of anybody's portfolio. It should be, looked at very carefully, because smart investors in the world, whoever any smart investors, they are very, very careful about their asset allocation. They pay a lot of attention to it, because asset allocation defines 80 to 85% of your overall portfolio return, and scheme selection, counts for 15 to 20%. So, but uh, we see usually we see people are asking more on the scheme, कौन सी scheme अच्छी चल रही है, कौन सा stock अच्छा चल रहा है, which, this scheme I think has given a lot of good returns, should I put money over there? So, instead of asking for which schemes are good, it's a valid question, but, asking what is the right asset allocation for me, what should be a suitable asset allocation for me, that should be the first question. And that is the most important question to generate portfolio returns, or for, having a successful investment in the long run. So, now we are going to talk about the 5 financial mistakes to avoid. So basically, these are the traps, you need to avoid to ensure that in the long run, you get good returns on, or over your portfolio. Many times, when you fall for these traps, you end up losing a lot of money, a lot of savings you have, got over the period of hard work. So first is, some people may disagree with this, but I would say, very important. Do not own liabilities in the beginning of your career. Buying a house with EMI, with loans, is a liability. So I would really recommend, don't buy a house early in your career. And I have 3 very important reasons to explain why you shouldn't. First is the convenience aspect. With convenience aspect, I want to say that, in case, because we are living in a very fluid world, there is high uncertainty. We really do not know how the world will be in next few years. So tying up yourself with EMIs, which are very high compared to the rent you probably pay, you won't be able to meet these expenses of EMI in case something unfortunate happens. So, convenience is also in terms of, the jobs. Probably, we are living in the world where you probably get a job in another city, and you would like to move to another city, better job, the job that you aspire for whatever reason you have changed your job. Then it shouldn't bound you to a particular city, because I have a house in in Delhi, and I got an offer, job offer, say in Google, maybe in Bangalore. So I won't be going there just because I have a house. But so what people usually do is, like, they they have already a house they're paying EMI on. They go to another city. They take another place on rent, and they put their own place on rent in, say, if it's in Delhi, they put it on rent. And so what exactly happens now? You're dealing with 3 things. You are dealing with the tenant who is staying at your own place. You are already also paying for the rent in your new place, and you're also paying the bank EMIs. So it becomes very inconvenient. It's not easy to manage a tenant, upkeep the house, and all of these things bring a lot of inconvenience to you. I have a friend who has bought a house in Gurgaon, and he got a job opportunity in Noida, where he's a senior HR in that company. he has to travel every day for 2 hours, on one side and 2 hours back. So these 4 hours of traveling happening in such a way that he's missing out a lot on his family time, on convenience time. So he's spending 4 hours just driving. So he's getting tired, and it affects his health also. So that's where convenience, when you're convenient, when you're not owning a house, you are staying on rent, then you have a convenience of moving to any place. If your office location has shifted, your job has shifted, you can always buy closer to your job. You can always rent, sorry, not buy, you can always rent closer to your office location. So that is one. Second is the better lifestyle aspect. Again, so for example, if you are staying in a house which is worth 1 crore, uh, we have very low rental yield in India, which is in the range of 2 to 3% depending on location to location. So if you're even paying 3% rental yield on the house worth 1 CR, you are paying a rent of 3 lakhs every year. So monthly it comes out to be 25,000. So you're paying a rent of 25,000 every month for that particular rented accommodation. And on the contrary, if you have bought a house of 1 crore entirely on loan, then you have to pay EMI of roughly 80 to 90,000 per month. If a loan period is 20 years, and the home loan rate is in the range of 8 to 9%. There's a vast difference between rental yield that we have in India and the home loan rate. So this difference is not much in other developed economies, or even not so developed economies as well. So the gap between rental yield and home loan rate is very less in other economies, whereas in our country the gap is very high. So instead of paying a high EMI of say 80 to 90,000, you can stay on rent. Say you are paying just 25,000, and what are the remaining amount you probably would have ended up paying in EMI. So that, for example, if you had it could have been an EMI of say 80,000. Then 55,000 you are left with if you choose to stay in a rented accommodation. So that 50,000, 55,000 can be invested in maybe an equity mutual fund or a mix of equity and debt mutual fund, targeting a goal which is buying a house, say after 15 years or 20 years. So in case you are staying in a rented accommodation, you can afford to stay in a good location by paying 25,000. Whereas if you want to stay in a good location, you will have to shell out 80 to 90,000 per month. But in case you decide, okay, I want to reduce my EMI, can pay only 40,000 EMI per month, then you have to choose a location which is not as good as you could have stayed in a rented accommodation. So that's where you have to degrade your lifestyle aspect also. Last and very important aspect of not buying a house early in your career is economical aspect. So in terms of as I explained earlier, rental yield and home loan rate, there's a vast difference in that. So if you choose to stay on rent, paying say 25,000 and remaining amount in long-term investments, you would earn enough amount. You would have created enough funds in 15 to 20 years time period to be able to purchase the home from that amount by paying 100% down payment, and you will still end up saving some amount to ensure that you can meet other goals. Because when you invest for long term, you can ensure that your returns are higher than the appreciation in real estate. So if a real estate in India is growing by appreciating by say 5 to 6%, and you are investing in a portfolio which is generating even 9 to 10%, you end up getting much higher returns over the long term, and you can afford to buy an entire house at closer to your retirement. So why closer to your retirement? Because at that point in time, you are very much, sure of where you want to spend rest of your life. Because the way we are living, there have been a lot of changes. The city structures are changing. So you may not like to, stay in the same city where you're staying right now. Post your retirement, you may choose to, stay closer to hills. So that is also you can do, and you would be aware of where you finally want to spend the rest of your life. And that's why I would recommend that choosing buying a house closer to your retirement would make better sense. Second trap we should avoid is outcome bias. So, what outcome bias means is that many people focus on what is the outcome and not, look at the context or the process through which that outcome happened. Uh, in that manner, many people look at, when they choose to make any investment, they look at the historical returns on mutual funds, and without realizing, the historical returns probably appearing very good, say 15-20%, and they believe that okay, they will also get the similar kind of returns in the next 3 to 5 years period on their investments. So they do not realize probably, when the returns are appearing very high in the in historical terms, probably the starting point is something when the markets were very cheap. And when you're investing today, maybe the markets are too expensive now, so you cannot expect the similar kind of returns. So majority of the people look at the past returns, end up investing in expensive market, and then they get disappointed. And then there are stories of many people, they say, I do not make money from equity, equity markets are not for me. But in reality, it's that you yourself have done wrong. You have taken wrong decisions, and you ended up getting poor returns. You're bound to be disappointed if you are not taking proper you have not giving proper thought to your investments, and not understanding the overall factors which influence the returns in the long run. So the point is, the favorable situation, which resulted in a particular outcome, may not be favorable today, or may not be favorable in future. So one needs to keep a track of these situations over the horizon of, over the journey of your investments. Third is, you must avoid procrastination. So basically, you need to invest early. Just to make it clear, imagine someone starts a monthly SIP of 20,000 at the age of 35. So investments are done for a period of 10 years. Total investments have been 24 lakh over a 10-year period. And the rate of return is 12% per annum. So at the time of retirement, so this guy planned an early retirement. At the time of retirement, at 45 years, the retirement fund is 46 lakhs. Whereas, another chap started investing at the age of 25, and he's making investments of say 10,000 per month. Again, it's for 20 years. The investment amount is 24 lakhs, and the returns are 12% per annum. So at the time of retirement, at the age of 45 years, the investment corpus is 1 crore, roughly 1 crore. So as you can see, the total investments done by both are 24 lakhs. But the returns here, the investment amount finally, there's a significant difference. So the first guy, getting even less than 0.5% of what the second guy got. So the idea is that the sooner you start investing, the sooner your money will work for you, and you will end up getting better returns, better gains over the long period of time. This is the power of compounding. So as Albert Einstein also said, the power of compounding is the eighth wonder of the world. So there is a lot of weightage in this quote, given that power of compounding does not add up in a way that we can imagine. It really adds up in such a manner that it's exponential as we continue to hold it for a longer period of time. So invest early, don't procrastinate. So next is never mix investments and insurance. When we begin our career and we open the bank account, it happens many times. Some of our relatives will come and say that you buy some insurance policy, or maybe if you are going to the bank, they will suggest you take some insurance plan and save taxes. And many people end up investing in very poor quality investment products linked to insurance and end up getting very poor returns in the long run. So it's very wise not to mix your investments with insurance. So whenever you want to make investments, it should be done in pure investment products. Pure investment products are like mutual funds, FDs or PPF. And whenever you want to take insurance, go for a term plan, a pure insurance product, where you can pay a very less amount of premium and you get a very big cover for your safety. So that is something very important to understand. You should not mix insurance with investment. Now the question also comes, why then your relative, distant relative, or your bank relationship manager will be recommending you for insurance linked investment products or ULIPs or pension plans? uh, the simple reason is that they get a lot of commission out of these products. So whenever you are not paying fees, you are getting something free as it appears. You are any agent or anyone who is selling you those products, they are getting commissions, and their interest solely lies in getting the higher commissions. So if they are getting higher commissions, that means you are getting poor investment. So you should never mix insurance and investment. It should always be separated. Uh, and in the last, I would also say that you all must have a health insurance cover. So although I understand that companies offer a health insurance cover, but as I explained, nothing is certain. You should have your own health cover as well, because maybe say 5 years down the line or 10 years down the line, you move to some other location, and that time the insurance cover will you won't have an insurance cover from the company. Then you have to start your own insurance cover. Given that lack of track record of your insurance, you will have to end up paying a very high premium when you start your independent health insurance cover in the later stage of your life. So it's better always to start your insurance as early as possible, so that you can ensure that your health coverage is maintained and you do not end up paying very high premium over the coverage period. So basically, in our investment management industry, there is a lot of conflict of interest, because an agent or a distributor or a bank RM is looking at his or her own interest by selling or pushing certain products which are which are generating higher commissions for them, and which are may not be suitable for requirement of any investor. So what happens, like whenever you're getting advice from any such kind of people, there's a definitely conflict of interest. As a matter of fact, in mutual funds also, there's different mutual fund schemes have different commission structure. Debt mutual funds will have different commissions, equities will have different commissions. Within equity also there would be different commission structure. So there could be a tendency of someone who is selling these kind of products to recommend those products which are getting him or her higher commissions. So that's where SEBI came up with investor advisor regulation in 2013 to address such kind of conflict of interest. So give you another idea of how conflict of interest impacts you. Whenever you are making investments in equity and debt mutual funds, and imagine markets are too expensive, then ideally your equity exposure should be reduced from your portfolio and your debt exposure should be increased. But when that happens, it affects the commissions of the agent. So he or she would not be in favor of recommending reducing the equity from your portfolio. So I'm not saying that all of them are like this. There are very few people who are also, act as a fiduciary. But majority of the people have these kind of commission, some targets where it's very difficult for them to manage client interest and also meet their targets. So, you know, to avoid such kind of conflict of interest, it's important that you must, hire a SEBI registered investment advisor, because they do not earn from commission. Whatever the products, whatever the investments they recommend, they never get any commission from these products. They earn only from the fees that they charge from you. So that fees is also something, could be, in terms of value addition, or could be in terms of, the commissions that he helps you save by investing in zero commission products. So you also do not need basically product peddlers or salesmen to sell you, push you products. You need someone whom you can rely on, who can give you a holistic advice on all your investments. It could be investments in, say, a commodity, also maybe a precious metal gold. It could be in real estate. It could be in different debt products or in different equity products. So there are holistic advice is required on your portfolio, and not particularly selling or pushing of any scheme or any product. So as I explained, the SEBI registered investment advisors do not earn from commission. So they recommend investments in zero commission direct plans of mutual fund. Mutual funds also have two kind of plans. One is a direct plan where there are no commissions involved, and there is another is a regular plan. So regular plan have been the traditional mutual fund investment options, where there used to be a fund management charges and distributor commission. So regular plan have two cost components: fund management charges and distributor commission. That is paid out every day, every month, till the time your investment is outstanding, irrespective of whether a distributor or agent who has sold, or any bank who has sold these investments, whether they ever show up their face to you or not. These commissions, they are paid out till the time your investment is outstanding. Whereas in direct plans, you only pay fund management charges and save the distribution commission. You do not pay distributor commission. So as I was trying to explain through some examples, here the regular plan expense ratio is here, which is charged on your mutual fund investment. Here the direct plan expense ratio is reflected, tabulated here. The difference comes out to be in the range of 1.2 to 1.3% on equity side. So when you do invest in direct plans, you get higher returns by up to 1.2% to 1.3% on your investment compared to a regular plans. So right now, there are a lot of platforms which are offering, online platforms which are offering regular plans, and now they have some platforms which have come recently, like Paytm Money, ET Money, which are offering direct plans also on their platform. So one can choose to invest in those platforms. Either so obviously one would not like to invest in regular plans now, given that you're aware of how you can save more and earn more in direct plans. So naturally, direct plan is something you should be investing in. But the second question comes: so who will guide you? Because investment is not easy. You have to understand the portfolio. You have to understand the asset allocation. You have to need understanding on changing market dynamics, how it's affecting your investments, and what changes you need to make so to ensure that you end up getting better returns in future. So that's why it's important that you deal with SEBI registered investment advisors who do not earn from commissions. They manage your investments, they guide you throughout your investment journey and make investments in direct plans of mutual funds. So over the long term, you end up getting higher returns by saving commissions and getting better quality advice. So just to summarize, first is you should increase your savings more than your expenses when your income rises. Whatever you earn, you should have some savings, so basically do not save what is left after spending, but spend what is left after saving. Again, wisdom, nugget of wisdom from Warren Buffett. Second, create two buckets to understand where you should be making investment. One is for short term, another is for long term, and assign your savings and investment to these goals. Have a purpose assigned to your investments and savings. Mutual fund investments can help you meet your short term and long term goals. We must avoid some costly financial mistakes, which is key to create sustainable long term wealth. If we fall for any of these traps, we end up losing a lot of savings that we have done already. So it's very important to avoid. If we're able to avoid such if we're careful about such traps, we would have much better chances to become wealthy. Last, fee-only advisors have aligned interest. Consult with SEBI RAs for suitable asset allocation. They work for you, not for commissions. They advise, not sell. So thank you, everyone. in the end, I would just like to tell that we are, Truemind Capital Services is a SEBI registered investment advisor, where we, help prepare the financial plans. So we understand, we explain you about what should be your asset allocation. We guide you, advise you throughout your investment journey with respect to any kind of investment that you need, how much insurance cover you need, how much health insurance you should be having, how much, asset allocation and what amount of investments that you need to make. So these kind of, advice is always available at TrueMindCapital.com. And so we also help you, avoid these costly traps we discussed. So that way we ensure that, you are able to meet your goals comfortably.